Welcome to another episode of our podcast. I am Elvira Rodriguez, mortgage expert and real estate investor, and it is a pleasure to have you here with us. Before we dive in, don't forget to follow the channel and hit the notifications bell so you never miss an episode. And of course, if you would like to connect with me on social media, you can find me at Elvira Loans. Today, I am excited to welcome a very special guest, Curtis Dorsey and Ashley Mitchell, from a credit repair expert called White & Jacobs. If you ever wondered how your credit score affects your ability to buy a home or what you can do to improve it, this episode is for you. We will be diving deep into credit repair strategies that can make a real difference, whether you are planning to buy your first home or looking to invest in real estate. Welcome.
Thank you. Thank you so much for having us.
Thanks for having us. Absolutely. I'm excited.
That's great. So let's dive in with some questions and answers and see what we have here for you today. So Ashley, what type of negative items can you get removed from a credit?
Really great question, and obviously that's always what clients want to know when we're going through their credit report with them. But there's really not any one single item that we can't or won't have a success with. It's just based upon our years of experience. It allows us to set some realistic expectations based upon that, who that data furnisher is, and really essentially how long that item has been on the credit report. So we'll go through, we're very detailed with that information as far as setting expectations based upon our years of experience, but we go after late payments, charge-offs, collections, public records, items included in bankruptcies, repossessions, foreclosures. So there's really nothing that we can't tackle. And that is in accordance with consumer laws. Fair Credit Reporting Act does specifically state that consumers have the right to dispute items on their credit report as they see fit. So, a lot of times one might think that, hey, this item is not reporting, accurately, or they're confident, or maybe a level of uncertainty. And, for us, it's grounds for us to go after that item.
A lot of people think that they can do the credit repair on their own. Do you advise that? What are the pros and cons about doing it yourself?
I always tell people there's they can do a lot of things on their own. They can represent themselves in court. They could build a house if they choose to do so. I personally wouldn't recommend it, unless that's just your area of expertise. Exactly. But I wouldn't advise it. And what the bureaus have done in this day and age, really especially since COVID, is really pushing people to doing online disputes. And unless you absolutely know without a shadow of a doubt what you're doing, I do not recommend it. I do not advise it, especially utilizing services like Credit Karma, because what that does is it compromises on the overall integrity of the dispute, because it's all done via a computer. You don't have anybody, the element of human touch is crucial and critical in this. And, when you go in and you dispute information, essentially there's 4 points of data that are being verified: name, address, social, date of birth. And once that information is verified, even if you're disputing something else, maybe date of last activity, or, this was never late, but because all of those data points have already been verified and the bureaus do not, they're not detailed in their investigations like one might think, it just makes it really, really difficult to go back in later on because they've verified the information, maybe not necessarily the specific information that needs to be disputed, but it does. It compromises on the overall integrity of it. So I don't advise it. And we offer free credit evaluation and consultation. So sometimes people just need a strategy. Hey, what do I need to do? And it's also it's understanding and knowing how credit scores are calculated, and hey, what is going into my credit score so that I can do X, Y, and Z in order to yield the outcome I'm seeking.
Yeah, I completely understand that because I have clients sometimes that just by looking at some credit, I can say, okay, you do this and, maybe lower this credit card or something. But some of them, they hear a lot from other people that, oh, you have to pay down to pay off everything, which is a big mistake in some cases too, right? So it will
Absolutely.
actually affect your credit if you pay off everything, because then you have nothing reporting, right?
Absolutely. Not only that, but then the history is still going to be maintained on the credit report as well.
Yes.
So you may pay off that debt, but the only thing basically, for the most part, that you're going to be changing is going to be going from an unpaid collection account to a paid collection account.
Yes.
Therefore, you're not going to see that big of an increase in your credit score.
Yeah, and sometimes we do like a wizard on the credit, right? And I have seen a lot of the times that I run the wizard and say, okay, if you pay it, leave zero, you actually gonna have a lower credit score than if you pay it down and leave like a $10 at
Yeah.
least, $100,
Yeah.
as a balance on that account. But I understand that a lot of people, they follow some other guidelines and then they ended up messing up their credit on that.
Or they follow through what their friend did, and
Yeah.
obviously it's not going to be the same rule that will apply maybe or get the same outcome. But we have a lot of loan officers they'll run their clients through like credit expert, you said credit wizard, and it doesn't give them the answers that they want, or maybe it gives them the outcome is the wrong answer.
It is.
They do exactly what it said it to do, and their score doesn't increase at all. And that's usually just because we're looking at credit reports all day long. So we can usually know, hey, by doing this, do this, here's the outcome that will be achieved. And, I do not recommend going in and paying off old unpaid collections, because it will. It's going to update the data last activity like we just talked about, which will then cause the credit score to drop. Now, I do, as far as giving advice to clients, if it's a charge-off with an original creditor, so let's just say Chase, Bank of America, Wells Fargo, it's still reporting a balance, then, I will advise a client, hey, if you want to see a credit score increase, go ahead, get that thing settled, because this way it'll no longer show to have a balance, so it'll zero it out, which will, not make it appear as though it's 100% maxed out, because whatever the balance is what the limit is, because you can't charge to it anymore. And then in addition, it'll also remove any past due balance. So you will actually gain points by going in and paying off an old unpaid charge off with an original creditor.
So just a question on that charge off, because I do see that some, like I have some clients that has several charge offs, right? And I know that sometimes just by paying off is not gonna really do anything with the credit. Is it? I don't know how easy it is, or if it's is doable to remove a charge off from the credit. I think you still have to negotiate some kind of a settlement for them to do that. No.
Many years ago, yes. So prior to 2013, 2014, which was when the credit bureaus, and this is just my personal opinion, my soapbox, but the credit bureaus went through and had virtually all of their data furnishers sign new contracts, new agreements with them, and what that stated is that they could no longer agree to do pay to deletes. Okay. So I remember prior to that time frame, 2010, 2011, where a client would reach out to Chase, or we'd reach out to Chase on behalf of the client and negotiate a settlement. And a lot of times with that negotiation would be if the client pays the account in full, Chase would remove it. Now, that's not something that they do anymore. Original creditors will not do pay to deletes. Now, there are collection agencies that will agree to do pay to deletes, or even doing a settlement. But your original creditors, those days of pay to delete are long gone.
Yeah. And then the probability of the collection agency going back in after you make the payment or whatever, removing it, is pretty much kind of like a hit and miss chance. I mean, it's 50-50 that they're going to actually go in and remove it off the credit report.
I would say that for them to negotiate, it would be better to have somebody on their behalf to negotiate that, to have something in writing before they pay. That have something in writing before they actually pay to confirm that they will delete that or remove from the credit by
Absolutely.
paying that amount, right?
Absolutely.
Okay.
Absolutely.
All right. So how does the credit repair affect my scores on the long run?
This is a lot of times. I'll take this question on because this can be a little bit of kind of a misnomer, but a lot of times people have this level of assumption, oh, I'm paying for credit repair and therefore automatically my score should increase. But there are so many factors and variables that go into how a person's credit score is calculated that, sometimes going in and removing negative information can drop the credit score. And or when we're going in and we're disputing information on an account that, let's say, maybe they haven't reported or updated it in quite some time, we are going in there and kind of stirring the pot, so to speak. And so it will re-report, and by it re-reporting, there can be a credit score decrease. However, as long as the clients go down the path that we're putting them on in terms of the overall strategy, it's just, it's kind of like, hang on, just bear with this here. We are able to overcome it, but it is kind of part of those, negative side of credit restoration.
When you do those disputes, if you haven't opened a dispute at the time of closing, you're not going to be able to close on that loan that day.
Yeah, we do have to get those disputes removed.
Absolutely.
Yeah.
So
and by the way, removing the disputes may decrease the scores as well, depending on how old or how much it is. I don't know if that is what affects, but it does affect by removing the dispute. But again, to do a home loan, the lender will not accept an account that has a dispute on
Absolutely.
it. Mm-hmm.
And then they're going to pull your credit right there at the closing one last time. And if any of those disputes have popped back up, again, you won't be closing on that loan.
If it pops back up or any account that they just opened or anything like that, we have to explain why did they purchase something during the time that we are doing the loan. And believe me, there are tons of people that do that, right? So don't buy anything. Don't apply for any credit or anything if you're buying a house. During the home loan process, don't apply for anything. Let it close first, and then you buy your furniture, your refrigerator, whatever it is, but don't do anything during the time that you are in the process of a home loan. Right?
And we reaffirm that our process it's truly catered to get people on the path to home ownership. So we're reaffirming a lot of those same things that you are, which is make sure you pay everything on time. Don't open up any new lines of credit. 2 months of bank statements, be prepared for those. But just to give you a background story on dispute remarks, dispute verbiage, because I remember when, that became an issue for investors and going through and making sure that, they disputes were removed, because when the mortgage meltdown occurred, that was one of the things that they were going through and looking at those banks was which accounts had dispute remarks, dispute verbiage, because it was included in Fannie Mae and Freddie Mac guidelines that there could not be dispute verbiage. So a lot of those loans that maybe had been foreclosed on that had dispute remarks, dispute verbiage, and they were going back in and making them where the loan originated from, buy back those loans. So that's really why we saw such a shift to that. And, for me personally, going through and, making sure that the client does close on their home, but now we've got this, objection to overcome and removing disputes. And so we would go in, we would remove the disputes with the bureaus, lender would pull credit, and scores would tank. And for me personally, because, my livelihood solely depended on making sure that we got this person to the finish line, as well as, working hand in hand with the loan officers. We're a direct representation of you all. And so clients were getting frustrated, and, we really did. We took a deep dive into what's going on, what's causing this, why is this happening? And what we found was with collection agencies. So some of the bigger ones, LVNV Funding, Midland Credit Management, Portfolio Recovery, Asset Acceptance, which got bought out by Midland Credit Management. What they were actually doing was, when it would be disputed, instead of marking it as a consumer dispute under the FCRA or maybe even FDCPA, they were marking it with the bureaus disputing it under the Fair Credit Billing Act, which Fair Credit Billing Act only applies to original creditors. It does not apply to collection agencies because it's just, for example, if you purchase something on your credit card and then you don't ever receive the goods, you have the right to go in and to dispute the item. And what's going to end up happening is the credit card company, while it is under investigation, it's going to get pulled from the statement. But what these collection agencies realized is, okay, by us going in and marking it as disputed under the Fair Credit Billing Act, it gets pulled from the scoring equation entirely. So they were utilizing that as leverage to, okay, hey, we'll go in and remove this dispute remark, dispute verbiage, but you're going to have to pay this debt.
Oh, wow.
So it took a little bit of, lots of investigating, lots of looking at the actual reports from the bureaus, and that's where we saw the consumer dispute statement and pinpointed. And since then, we don't see it near as much, so the scores aren't taking. But because there is still, movement shifting within that data and how it gets put into the scoring algorithm, so it can cause a score to drop some, but definitely not how it was, years and years and years ago when this change was implemented.
Okay. I have a question because this is one thing that I deal a lot with clients, right? They wanted to apply for a home loan. They don't want me to pull credit because it's going to, bring their scores down. So right now we are actually doing a soft pull, and then if it, if we get them approved and so forth, and when they get a contract to us, then we will go ahead and pull the hard pull, right? But one of the things that we have a lot is, you pulled my credit, and the credit, you're saying that I have a 690 when I see online that I have a 730, right? And explain to us what is the difference, because I would like them to hear from the experts, right? Why the online credit score is higher than a mortgage loan credit score.
Absolutely, we get that question a lot. I mean, even it can be very agitating for some clients, and they get angry at us. But the biggest difference between consumer credit scores as well as lender scores is just that it's a lending decision, lending criteria that goes into it, as opposed to a consumer credit report. They're the ones that are pulling their credit to ensure almost levels of accuracy. So there's not that same lending decision criteria that goes into it. In addition, till 2006, we just had your traditional FICO credit score. And since 2006, there's been the introduction of Vantage, which Vantage is actually owned by the three credit bureaus, Equifax, Experian, TransUnion. And in 2006, I think this is just to kind of dote on FICO, but in 2006, Fair Isaac Corporation sued the three credit bureaus because how they deemed it is they deemed that their scoring algorithm, Vantage, was actually a monopoly. Because not only do you control the information that is being, reported out there and available for lenders to pull, but now you're also controlling the scoring algorithm. So Fair Isaac did sue the three credit bureaus. It went all the way to the Fifth Circuit Supreme Court. They lost, which is now why we have Vantage Credit Score. But it's just a little bit of a different algorithm. When it first came out, it was on a scale of 500 to 1,000, which we're all familiar with FICO. FICO's the 350 to 850, and that has shifted to be more competitive with FICO. But even with mortgage enhanced credit reports, there are different FICO scoring algorithms, and the latest one is FICO 10T. I don't know if you're familiar with it, but it is really more comprehensive in terms of trended data, and I think that we'll probably begin to see that more on mortgage enhanced credit reports, just to ensure that Fannie Mae and Freddie Mac guidelines, majority of lenders continue to use FICO, because as of October of 2022, Fannie Mae, Freddie Mac did allow in their underwriting guidelines Vantage scoring. So we'll see what happens, but it's interesting.
And there is a new thing coming up, right? That they are gonna not count anymore or report anymore medical collections. Is it? If you can,
Yeah, absolutely.
Tell us about that as well.
So CFPB has some recent press release, and it's pertaining to medical items. It takes about 60 days for it to go into effect. And so this was in January when this was put into place. So we'll see what happens with the CFPB, because it's my understanding that the CFPB is also on this administration's, it's on the chopping block, but we'll see what happens. But based upon the verbiage and the press release that the CFPB provided, which is your Consumer Financial Protection Bureau, it states that on the lender reports, medical items, cannot appear and or, can't get factored into the credit score. So there is some pushback in terms of legislature is concerned. Their exact words from one representative was that it's a lawless decision in terms of what was made, but we'll see what happens with it. And just like you, I keeping my fingers crossed that it actually does happen, and that there is more consumer protection for people associated with medical debt, that it shouldn't get factored into it, because our medical system isn't perfect.
Yeah, and also because on those medical collections, they already know that they cannot report to the bureaus, right? If they don't have something in writing, right? But even before that, wouldn't they have to have something in writing that they signed by the client that they could report to the bureaus? Mm-hmm. And that's how it was being removed, right? You can dispute that and remove because they don't have anything in writing that they signed, so they could report to the bureaus. Is that something correct or no?
No, that's because it's not to. It's usually so when a person goes to like a doctor's office or hospital emergency room, what happens is when they are signing those releases,
particularly the HIPAA form.
Well, HIPAA. So, but basically, what it states is that their medical information and their data will be used in an attempt to collect. So it doesn't state, hey, if you don't pay this, that we're going to report it to the bureaus, but it does provide that disclosure that if you don't pay, that your information will be used in an attempt to collect. And so that is something that we do go after and we do request from those medical collection agencies, is the validation associated with it, because a lot of times what they'll do is they'll just provide maybe a statement of summary of services. However, they will not provide the HIPAA release that states that they have the right to go in and attempt to collect. So that gives us additional ammunition for us to go after them, because obviously at that point in time, not only is it a HIPAA violation, Health Insurance Portability Accountability Act, but it's also an FDCPA violation, Fair Debt Collection Practices Act. Okay. It's a little bit of a game of cat and mouse, but there is definitely there's a method to the madness, and that's just with our years of experience setting those expectations for clients based upon what we've had a success with and what we haven't had a success with, and how the laws work. Because especially in the state of Texas, you've got your Texas Debt Collection Practices Act, which is, in my opinion, has a little bit of a heavier hand than even your FDCPA, and is very specific and very precise about what collection agencies can and can't do.
So how does really a hard pull affects the credit or the points on a pull? A lot of people don't want to pull credit report because they think that their credit score is going to go from 700 to 600, which is not the case. Yeah. Right? So what is your input on that?
Yeah. No, you're exactly right. It's not. It is an inquiry is not going to drop the person's credit score that drastically. And what we advise clients when it comes to inquiries is you're allotted a reasonable amount of inquiries per year. And it's, kind of 4 to 5, 6, 7, around that many. They will remain on the credit report for up to 24 months. However, they only impact the credit score for up to 12 months. And, as far as an exact, how much it's going to have an impact on the scores, we really don't know. But what we do know, and this is just FICO, if you go to their website, they're very detailed in this. But the higher a person's credit score is, then the less an inquiry is going to have an impact. Yeah, because how it's deemed to the scoring algorithm is they're shopping around in order to get the best deal, as opposed to The lower a person's credit score is, it's deemed as though they're just shopping around for somebody to say yes to them. So it's going to have more of an adverse effect the lower that the credit scores are for an inquiry to appear.
Okay. And so when they call it a soft pull, it's because it does not show on the credit bureaus, the inquiry.
It does. It does show. Yeah. And any time you pull your consumer credit report, let's say through Credit Karma or Experian.com, because that is the makeup of your credit file essentially. So it does report, it does show. And I would strongly encourage anybody to, go to Experian.com, TransUnion.com, maybe not so much with Equifax because those reports can be like 100 pages in length. But when you see the level of detailed information from Experian, from TransUnion, AKA information, addresses, consumer polls, lender polls, the overwhelming amount of information is unbelievable.
Yeah.
Mm-hmm.
So
a lot of data.
But in short, the soft pull does not have as big as impact as a hard pull.
Correct. Yeah.
Correct.
It's very, very minimal because it is still being pulled from a lender, so it will have some slight impact, but not near to the extent that a hard pull would.
Can credit repair help with the student loans? Because I see a lot. Student loan is an auto thing. A lot of people don't pay attention that they just finish school and they have only 6 months grace period.
Yeah.
And then they forget. And then what happened? Whenever they are going to apply for a loan, they didn't start paying because probably they didn't even receive any correspondence about it that they needed to make the payments. But then they have all those late payments with the student loans, and on FHA loan, if it goes to collection, then that's another problem because they're going to have to pay that, right? Yeah. So how hard is it to remove student loan delinquencies?
So as far as, and we'll go through and we'll analyze a credit report, but usually what we see for student loans, and since we're just now coming out of the deferment period that occurred with student loans for the protections associated with the CARES Act due to COVID-19. So we're not really seeing a lot of student loans that are in collections because they are just now coming out of deferment from January of 2020 till roughly September of 2023. What we're seeing with student loans, and even during that time frame, during the deferment, there was no interest that was being applied, which is good. But where we see that student loans are adversely impacting a person's credit score is whatever the loan amount that they took out. So let's just say it was maybe $5,000, and because it was deferred, and now the current balance on that account is maybe $5,500. So the balance currently exceeds the original balance, which is never good. So it makes it appear as though it's over 100% maxed out. So that does adversely affect the credit score. Late payments, we do see those as well. And our strategy for late payments, as well as getting that opening balance at the same so that they can start paying it down and not, have it just be an over exorbitant amount, is we'll recommend doing a consolidation. Okay. So we have an email template. We try to make it as easy as possible for the client so that this way they're not overwhelmed. It's not one more thing, but there is definitely a strategy associated with it. And then if they are in collections, then we're going to be advising them, hey, you've got to reach out to the U.S. Department of Education, if they're federally backed, because, you can't include student loans in a bankruptcy.
And we cannot do a loan with those collections on a government loan.
Yeah. So we're going to communicate that information so that we can get them mortgage ready. But there is a little bit of a strategy associated with student loans when we do have them go back in and do a consolidation, start making payments to it, maybe doing it on a reduced income payment plan, so that this way a minimum payment is actually being applied to the credit application, as opposed to y'all configuring maybe 1% or half.
FHA is 0.5%. Yeah.
So, but this way they'll have that minimum amount as opposed to what y'all would normally factor into it if it was deferred. So we definitely try to do anything and everything that we can to help them out, and maybe even to help out their DTI for that period.
So talking about that then, so you guys do have a consolidation program that you guys offer to put them into consolidation, or no?
No, we it's something that they can do on their own.
Okay.
They don't need a third party to assist them in helping them do that. We've got an email template put together, and it has step-by-step instructions so that this way
Awesome.
they can do that on their own.
That's really good. So if you have student loans out there that is in collection, or a lot of lates and a lot of student loans, and you don't know what to do because you're just overwhelmed with it, give us a call. Curtis is here to help, and we'll send you. They will send you instructions, detailed step by step, how you can get those loans consolidated. Right?
Absolutely.
How do you guys address identity theft in the credit report?
So we, and obviously it's the fastest growing crime in the United States is identity theft. But we're going to go through, once again, really evaluate the items on the credit report, because sometimes people think that they've had identity theft, but really at the end of the day, it's a mixed file. But if for certainty it is identity theft, then it's, for most people, it might seem like an overwhelming process, but we really have taken the guesswork out of it. So we've got some paperwork that we're going to email over to the client to have them fill it out and maybe, get it signed, notarized by a public notary, and or get a police report. Also go to FTC's website and fill in that information and then provide us with the FTC complaint number. So that's really the main nuts and bolts of it. We like to be very clear with clients that because of the fact that it is an ID theft affidavit, it is subject to penalty of perjury. So I know that there have, and especially in the news too, there have been other credit repair companies that's how they'll go after everything, is by utilization of an ID theft affidavit and claiming everything is being fraud. And I would not ever recommend that to my worst enemy. So if somebody recommends that, but the person knows that the account is in fact theirs, under no sort of circumstances do not take that direction, take that advice, because they really are cracking down on it.
And you can find yourself in a lot of legal trouble behind that.
Yes.
And I know right now it's a lot of people on Instagram that's doing that, filing just across the board. Will take your credit report and just file affidavits on each account.
Oh wow.
There was a lady that did credit repair in Houston, and her Instagram, she really did. She had great advice, but that's people's level of assumption is, I'm paying for credit repair, or I'm utilizing credit repair, and therefore it's going to resolve everything, and that's not the case. But the lady out of Houston was arrested, and she had $2 million in fines and charges against her. Yeah.
And also be prepared. If you file an affidavit, a police report or whatever, what we find most likely is if somebody's stolen your identity, it's probably somebody close to you.
Oh, yeah.
It's going to be a family member in most cases. So
yeah.
Unless you're ready to file charges, yeah.
What happens if a creditor refuses to remove a negative item from the credit report?
You can't force their hand. And our agreement specifically states that we cannot guarantee removal of accurate, verifiable information. This is also in compliance with CROA, which is your Credit Repair Organizations Act. This is a federal law that was enacted in 1992. So once again, just because a person is either utilizing credit restoration and or disputing items on their own, does not mean that it's going to get removed. So there is lots of strategies. What's data last activity on the account? So, that's a big one for us, is being very specific and very precise, because statute of limitations is 7 years from the original date of delinquency or data last activity. So, hey, is it getting close to the statute of limitations? Is it a paid item from a couple of years ago that, hey, maybe it's not worth that creditor or collection agency to respond? There's lots of different strategies that we're able to utilize so that this way our audits, our investigations, our disputes are authentic, and we're just not throwing a blanketed never late or not my account, and those are very valid disputes. But at the end of the day too, as our consumers, we're at credit bureaus, creditors, collection agencies' mercy. And I can't tell you how many times when I have seen very, very clear violations, infractions of those federal laws, and it's like leading a horse to water, especially with the bureaus, to get them to report that information accurately and or delete it. So in those escalated cases that we often do have, we not only do we have an attorney in-house that we utilize for our clients that are here located in Texas. We also have another attorney that we work with that we are able to utilize his letterhead for the states that he's licensed in, which is Texas, Colorado, as well as Georgia and Washington, D.C. But we also have an attorney that we work with that's his niche. He is a huge consumer advocate in consumer laws and does like to litigate, which a lot of your consumer law attorneys do not like to do. So we really have an arsenal of tools that we can go to. But once again, just based upon our years of experience, we're going to be able to advise clients accurately. And I know we have a lot of clients, they might be super frustrated with the item and they're like, they haven't responded or they haven't done this. And it's not always grounds for a lawsuit, and or it doesn't always mean that item should get removed. But, we understand, it's like a thorn in that client's side, and there's a background story to it, and it's been ongoing for years. So, seeking a resolution, we understand allows our clients to really kind of move past what took place in the past.
Talking about that then, so if I've heard, I'm not sure that is 100% true or what, but are there companies or creditors such as Midland and I know that's another one, I think is Charter Communications. They are I think Charter, I had already talked to them one time with a client and they will not remove anything from the credit.
Yeah.
But I've heard that also Midland is a very difficult one to get things removed from the credit from it. Is there any saying on that?
You're very Midland Credit Management is difficult, very, very, very difficult, and so it comes down to it. Hey, is this item in fact yours? Mm-hmm. And if it is, and they continue to verify it and not remove it, my best recommendation for that is to settle it. Mm-hmm. And a lot of times by settling that debt, Midland Credit Management will remove it.
Okay.
As is LVNV funding, as will, portfolio recovery. And they're debt buyers, so they're not attempting to collect on behalf of the creditor. They go in and they buy up that debt and they buy it for pennies on the dollar. So there is negotiating room as much as they might not like to necessarily, especially this time of the year where people are getting their income tax refunds. We're past the holidays, so they really don't like to negotiate during this time frame. But there is wiggle room, and you can negotiate for them to remove it.
I just had a client that we did a loan application, and last year her score was 797, and end of the year passed and all that. So she came back and said, "Okay, we are ready to purchase now." And when I pulled credit, there was some lates on Chase credit card. Mm-hmm. She said, "I don't owe anything on Chase credit card." So what happened there is she paid off the card, but next month, I guess, she had like $2 or $3 in interest. Mm-hmm. And because she didn't pay, because she doesn't get anything, she thought that she paid off everything. Yeah. And then they started putting late fees and then late on the credit. So she had like 5 lates now. Mm-hmm. And her score from 797 went down to 650 something.
Yeah. Wow.
So is there a way to rebuttal that or get that removed?
So Chase, in my personal opinion, in regards to situations like that, they are the worst. Mm-hmm. I had a similar situation with a real estate developer that built hotels. So obviously his credit was an absolute imperative that was impeccable. And when he'd established the Chase account, he lived in Florida and had moved to Hawaii. And so the state that he was in, they didn't have any Chase accounts. So he coordinated with a Chase banker, flew to California to close out the Chase card, paid the balance in full, and it wasn't like it was a couple $100. It was, it was business expenses, but closed it out. And then because of the fact that they sent the statement to his address in Florida where he no longer resided, same thing happened. And I spent countless hours on the phone with Chase, escalating it all the way up to their executive offices of the CEO, and they refused to remove the late, even though from my opinion, my scope, my perception, even though he was late, Chase should have done the right thing and gone in there and had some loyalty to their customer that really did do the right thing. But there was absolutely, there was none. And bear in mind, the banks win when consumers have less than stellar credit. And like I said, that's kind of been the big, change since 2013, 2014. Chase would, they valued their clients so that they would work with them. And if you pay this account off, then we'll remove it. But not the case anymore. There's definitely been shifts in that arena. So I would say, my heart goes out to that borrower because I understand that struggle. However, from our credit reporting stance and going after the bureaus as well as, going after Chase, it typically ends up remaining on the person's credit report.
Yeah, I did advise her to call Chase and see if they would. They did remove a couple, but not all of the lates. Yeah. And in reality, nowadays everybody wants you to do paperless, right? I don't like to do paperless just because of that, but I do have all my credit cards in auto pay, at least with the minimum, so I don't get missed, right?
Yeah. That's
but
great advice.
That was, it's so sad for her because she couldn't get the scores up. So now I guess it's only time, because a late can affect, as you can see, it dropped over 100 points just because of current lates. And that's what I tell people, whatever is lates in the next 6 months, it's hard. You can pay it off, you can pay it down. It's not gonna raise right away. It's a matter of timing now to rebuild that score. So of course, to pay it off would be the best bet at this point. But also it doesn't do overnight, or it doesn't do in 30, 40 days like usually you do if you do a rescore or something like that. But
I would even advise people, if you're going to do auto pay, actually set it up a couple of days prior to the actual due date. Because if there's any glitches or anything like that in the system, you don't get dinged for having a late payment.
And I don't know if I'm right, but I a long time ago I learned that if you pay 10 to 15 days in advance, at least the minimum, you gain extra points. And by dropping keeping your balance, monthly balance below 30%, you also gain some extra points, right? And I did have clients that followed to the point what I told them to do, and they did raise their scores in a month and a half, right? But it's not everybody that can do that. I have another borrower right now that I probably will refer because he's trying to get a HELOC, and but I need to do bank statements, so we need higher credit scores, and for them to qualify. And but the main thing that he doesn't have negatives. It's just that everything is maxed out.
Yeah,
and I said,
balances
you really need to lower those balances. But unfortunately, I cannot just do the cash out refinance and pay off those debts, because we could pay off everything but that affects the loan for qualification because the score is too low.
And that's probably why he's doing the HELOC, is because he want to pay off some of that debt.
Yeah, and that's what we were trying to do. Yes.
You are right about the 30%. So making sure that you do keep your lines of revolving credit at 30% or below. That's really when you're going to be able to maximize on the credit score, because the second contributing factor in how credit scores are calculated is your balances. So that's 30% of a person's credit score. Number one biggest contributing factor in how credit scores are calculated is payment history. So I always tell people, if you're going to do anything, just make sure to pay everything on time, and organically you're going to see the credit score increase. And if there's anything recent, new, whether it's a collection, a late payment, it roughly estimately takes about 24 months for it to be no longer deemed that of severity. Everything that has occurred within a 24-month time frame, how that gets factored into the credit score is more severe as opposed to something from, as opposed to something from, that's maybe 3 or 4 years old. So
Talking about timing for that, so if somebody has a bankruptcy, what is the statute of limitation for that to be on the credit? There is a period, right, that should be reported, and then after that it drops, right? Can you tell us how long does it take to drop a regular medical collection and then a bankruptcy or foreclosure if it does?
yeah. So federally, Fair Credit Reporting Act, statute of limitations for just derogatory items is 7 years from the date of last activity or date of first delinquency. And that's also, items included in bankruptcy. So whether the date of last activity was maybe a year before they filed for bankruptcy, that's what it's going to default to. But the actual public records itself is 7 years from for the Chapter 13, is going to be 7 years from the date in which it was filed. And it's actually a Chapter 7 that can remain on a person's credit report for up to 10 years. Okay. And because there is so much paperwork involved, everything is filed electronically online. Bankruptcies are very, very difficult to remove, especially if a person's gone in and done a Chapter 7. We've had clients like this where it's happened and they've completed the Chapter 7, all of the debt has been discharged, and they're like, I want to clean up my credit, and I want the bankruptcy gone. And it's not that simple. There's just time does heal, but Chapter 7 bankruptcies are very, very difficult to remove in this market, in this day and age. And when I first got started in the industry, that was one of my first clients that she had just gotten out of a Chapter 7 bankruptcy. It had been discharged for 6 months. And this goes back to 2004, so it was very different. Technology was very different. There weren't any, cloud-based servers, and we were able to successfully remove it, but not in this market, not in this day and age. It's very, very difficult. There are some strategies that we can impose as far as disputing the information, not only with the bureaus, but also LexisNexis, which maintains public record information. But once again, because of recency, it's going to be difficult.
So, Ashley and Curtis, why don't you give us a little brief about how you started in credit repair and what is the main difference between White and Jacobs and other repair companies out there?
Well, as for myself, I guess I was, during the time when the interest rates just really bottomed out. I was working for Countrywide Home Loan, their full spectrum lending department or whatever, where the rates were just exacerbated in terms of
subprime.
Subprime lending, and I just really got so infuriated when the market crashed, and a lot of those people was kind of left out there or whatever and had no place to go, and obviously their credit was definitely dinged and hurt by having losing their homes. Mm-hmm. And I got into the credit repair because I wanted to be able to help some of those people, to be able to kind of recover and get back to the positions and just living the American dream, getting back to that position in terms of home ownership. Yeah. So that's what kind of brought me into the credit repair aspect of it.
Okay. To help other people.
Absolutely.
Mm-hmm. Yeah.
For me, it's just totally it's just totally about helping people or whatever get themselves in their position.
Yes.
It's like you realize the opposite of getting people into a home loan with a high interest rate wasn't serving them, but obviously helping people improve credit so they can get better interest rates. It's
absolutely
much more rewarding.
Yeah.
So I've grown up in this industry. I started when I was 23, and I knew nothing about credit. Absolutely nothing. I had a single mom growing up, and so obviously she did her absolute best, but with 2 kids struggled, and so I saw that. So I didn't know about credit cards or credit or any of that, and I was getting married, and I was so fearful that my credit was going to transfer, my bad credit, my horrible credit was going to transfer to my husband. And so I was very, very fortunate that we knew a friend of the family that had started a business and was getting really, really busy and was needing to take on employees. And I jumped at the opportunity because I wanted to learn more about credit and I wanted to improve my credit. So that is, almost 21 years later, and here we are. And I definitely, I have my niche, and I love the ability and the opportunity to educate clients, really anybody that'll listen in regards to credit and what their options are, so that this way they have choices, they have options in order to get better rates, because everybody wins, in my opinion, when you're not being forced to make a decision that is not going to be the best for you or your family. And as well as in the market that we've been in over the last 4 years with in inflation and everything else, having excellent credit, it makes your dollar stretch more. So that's really our soapbox, and very, very proud that really is our mission for clients and White Jacobs and Associates. In addition to the fact, since we have been in business, we've always had in-house counsel. So having our company be attorney backed has just really opened up the doors and just allowed for a better understanding as to how these consumer laws work.
So that is a really good thing about, one of the main differences about White and Jacobs and other companies out there is that, having the attorneys on your group that can provide the support and go above and beyond the extra mile to get things removed from your credit. So, we would love to help you, and Ashley and Curtis are here. And if you have any question, just give me a call. The number below, or their information is going to be also below there. So feel free to give us a call, either one of us, and we would love to get you ready for the new house in 2025.
I always tell people that the worst debt that you can have is going to be having bad credit. Because, again, we spend an exorbitant amount of money in terms of paying interest due to having the low credit scores.
Exactly.
So, that can be the most expensive debt that you'll find yourself faced with, is going to be having the negative credit scores.
And having a higher credit score, it opens up so many more opportunities on the loan program. Because, for you to buy a house, there are hundreds of loan programs, but at the end of the day, each one of them is gonna have a better rate. Doesn't matter if it's a full documentation or bank statements or stated or no income, no assets, but all of that boils down to having a good credit score is gonna have a lower interest rate. So,
it's like giving
it's
yourself
time
a raise.
you give yourself a raise, and let's get together and get you started on this process. And that's a wrap on another insightful episode of our podcast. I hope today's conversation has helped you understand how vital your credit is when it comes to buying a home, and more importantly, how you can take control of it. Don't forget to follow the channel and hit the notifications bells so you never miss an episode. If you have any questions about credit repair or want to learn more, feel free to reach out to us. If you have questions about credit repair or want to learn more, feel free to reach out to us or connect with me on social media at Elvira Loans. Remember, improving your credit is the first step toward achieving your financial goals. Until the next time, stay motivated and take that next step toward your dream home. See you soon.